mode. Hello everyone, my name is Donna Kilborn and I'd like to welcome you to today's webinar on understanding rates and the rate cycle. Our speaker today is Rich Wilkinson, and Rich is the Director of Solutions Engineering with Unanet. And Rich has had 4 decades of experience in the industry, including working as a contracting officer with Nazaire, then a variety of finance and accounting leadership positions at leading government contractors, and for the last 20 years in senior leadership roles with a number of very prominent software companies and service providers, serving firms in the government contracting sector. We will have time for Q&A today at the end of the webinar, if time permits. So please type in your questions in the blue GoToWebinar dialog box at any time during the webinar today. We are also recording this webinar and will share the recording and the presentation with attendees after the event. So without further ado, I'd like to hand over this presentation to Rich.
Thank you, Donna. And good morning, everyone. Welcome to our webinar on rates and the rate cycle. We'll start with the basics of indirect rates. And for those of you that are already familiar with rates, don't tune out because we'll very quickly get to some very interesting information about rates and rate structures. We'll talk about the traditional structures and how to go about developing rates. We'll talk about some of the rate submissions, the prospective submission related non-rate submissions, and some of the course corrections that are required as we go through the year on with rates. We'll talk about year-end revised billing rates, something that almost all companies should do. And we'll talk about the dreaded incurred cost submission and its audit, and wind up with a few trends in indirect rates. For just a few seconds, I'd like to talk to you about Unanet. We're a software company. We do accounting, timekeeping, project estimating and planning, and budgeting for any kind of project-oriented company. We do the budgeting and planning part, the tracking part after you've won the job. We do the real-time analytics, key performance indicators and dashboards, billing and revenue recognitions, and financials for project-oriented companies. These are just a few of the logos that use our systems in one way or another, and they range from very small companies to very, very large companies. Unanet is a very scalable solution for companies that do what you do. Let's talk about the basics of rates. If you're in this business, you know that their costs are segregated basically into buckets. We have direct costs, and those are the ones that are directly attributable to a job or caused by a job or a contract. And then we have the indirect costs, those that can't be associated with a particular job or are associated with multiple jobs, usually lots of them, and need to be allocated across those jobs. Rates are nothing but a fraction. We take those direct costs, we put them in the denominator of the fraction. We take the indirect cost, put them in the numerator, divide it out, multiply by 100, and boom, you've got a rate, percentage. If I have fringe costs, for example, of $280K and labor costs of $1 million, that gives me a 28% fringe rate. Overhead of $400K, direct labor of $800K, and I have a 50% overhead rate. In creating those pools, or those fractions, the pooled indirect cost ought to have some sort of causal or beneficial relationship to the cost in the allocation base. Sometimes that relationship is nice and clear. You can look at it and say, of course, those costs ought to be allocated over that base. Sometimes that relationship's a little more esoteric, and it takes a little brain power to figure out exactly why those kinds of costs ought to be allocated over that particular base. Sometimes the relationship is actually dictated by the regulations, FAR, or cost accounting standards, as with the general and administrative pool. The regulations don't leave it up to us to figure out what we should allocate G&A costs over. It specifies three particular options, and we'll go into those in a minute. Let's start with fringe benefits. Those are most often pooled and allocated over a base of total labor. Now, some of that labor is actually in other pools, like the overhead pool or the G&A pool, including bid and proposal or independent research and development or IR&D costs. Some of it is in jobs that will be billed to customers, what the regulations refer to as final cost objectives. Those pools are intermediate cost objectives because the cost in those cost objectives or pools are going to be allocated to jobs later. The labor in the allocation base causes the pool cost to be incurred, or it benefits from the pool cost, such as the fringe benefit pool. For example, payroll taxes caused by just having employees. If you have employees and you pay them, you have payroll taxes. Paid absence benefits, same thing. If you have employees and you give them time off, then that causes those paid absence expenses. Same thing with health and welfare costs. So the basic rule of thumb is that the cost in the fringe pool should arise directly out of the employment relationship itself and not from any other business activity or outcome. It's not driven by winning a job or losing a job. It's not driven by any kind of overhead activities like managing projects. It just happens because we have employees. Overhead's a little different. Pooled overhead costs are often allocated over that same base, direct labor and B&P labor. Some of that labor may be in other pools, like the B&P labor in the G&A pool. Most of it's going to be in jobs that we want to bill to customers ultimately, a final cost objective. That labor in the allocation base, the direct labor, causes the costs in the overhead pool. It also benefits from the cost in the overhead pool. Supervision and training, for example. If I wasn't doing projects, I wouldn't have that supervision or that training. And certainly the projects benefit from that supervision and the training. Support costs, often IT costs, have that causal beneficial relationship. Often incentives and morale building activities have that causal beneficial relationship. Now, incentives are one of those areas where companies often say, but I have incentives because I have employees. Yes, but the amount of the incentives are driven by project outcomes. If those outcomes are good, those incentives are paid at a higher rate than if those outcomes are not so good. And that's a performance parameter. It means that it belongs in the overhead pool as opposed to in the fringe pool. Facilities costs are typically in the overhead pool, the heat, the lights, the water, the rent. Now, a portion of that may go in the G&A cost for the cost of housing the corporate people, the finance and accounting, office of the president and so forth. And so it's often split. But the majority of it's probably going to go into the overhead pool. And this is where companies often have two overhead pools, one that has facility cost in it for the people in their own facilities, and one that doesn't for employees who work on a customer site. The rule of thumb is that cost in the overhead pool should arise out of doing work for customers. So if you're doing billable work or B&P work, that causes the overhead cost. And if that causes those overhead costs, that's the pool they ought to be in. We talked a little bit about the fact that companies often have two different overhead pools, one for the labor that's worked on customer sites and one for the labor that's worked on company sites. And the difference between those two is simply occupancy cost. Some companies will have a facility service center and all the occupancy costs go in that service center and then are allocated out to the overhead pool and a little bit to the G&A pool, depending on how many people are in that pool. The costs are similar for the two except for those facilities costs. G&A is a whole different animal. Now these costs are associated with running the company and not performance, like doing work for customers. So these costs are going to happen simply because I have a company and I have to have executives for that company to run it. I have to account for the costs and bill my customers and do the finance and accounting work. I have business licenses and taxes. So the causal beneficial relationship is not as clear here. It's not common sense. And as a result, the regulations simply specify what your basis will be for G&A cost. You basically have three choices. It could be total cost input, and that is by far and away the most common G&A base. And that says that everything that isn't in the G&A pool is in the G&A base, with a few exceptions for unallowable costs that are never allowable. Value added is a different kind of animal. Value added says that all the work that I do that adds value to my projects goes in my G&A base, but the pass-through cost, the cost that I simply pass through to my client, like materials and subcontracts, doesn't go in my G&A base. In fact, it's often in the base of a separate pool called subcontract and material handling, often abbreviated down to SCMH. And that subcontract and material handling pool will be allocated over the subcontracts and the materials instead of G&A. We'll talk a little bit more about the value-added base later. And then there's one last option, and that's single element. And single element is rarely used by anything except consulting companies or very, very small companies. The single element used for a G&A base is almost always labor. So you'll find legal companies, CPA firms, those kind of companies for whom all the costs except labor are incidental. So they don't apply any kind of indirect rates to travel or materials or any kind of non-labor cost. Labor is their sole allocation base. And so since they only have one allocation base, they put everything in one pool. So single element often ends up being single pool as well. So here's the rule of thumb for G&A cost. In general, all the cost in the G&A pool should arise simply out of the fact that you have a business to run. So your executive staff, your finance and accounting, those kinds of costs are going to be in G&A. And the base for the G&A is going to be specified by the regulations. We don't have a lot of choice there. So review those rule of thumbs again. Fringe costs come from the employment relationship. Overhead cost comes from doing work for customers. G&A costs arise out of running the business. I often go through a process with new clients that I call purifying the pools and purifying the bases, where we go through the cost in each pool and ask a simple question: where does this cost come from? And if the answer for fringe is from doing projects, we move it to overhead. And if I look at a G&A cost and say, hey, this cost arises simply because I have employees, we move it to the fringe pool. And when we're done, we have a structure with the fringe costs, the overhead costs, and the G&A costs where they belong, and it's almost audit proof. DCA will come in and look at those and go, yeah, that's where those costs ought to be. And we get very, very few audit issues once we've been through that purification process. DCAA calls this particular structure the three-tier rate structure. They like the causal beneficial relationships we've talked about here in our rules of thumb, and they understand this structure. That's key. There are a million other ways to do this. 999,999 of them are going to be a little bit outside of DCAA's experience. They're not going to understand them, and that means they're going to give us trouble. So let's talk a little bit about the traditional structure. One rate applied to one pool or one base. That's that single element we were talking about. Law firms use it sometimes, accounting firms often, PR firms more often than not. And that means that when they have costs like travel, they don't apply any indirect rates for that cost at all. The two-tier rate structure is a little less common, and it's really the three-tier structure in disguise. It's a single pool for all the fringes and all the overheads. This is often used by small companies that don't want to fool with splitting their fringes and the overheads out. But they do have a separate pool for G&A. It's not very popular with the auditors and the contracts folks because they don't see it often enough, and so they don't really understand it. It also doesn't work if you have customer site and company site overheads. You can't put the fringes into the overhead pools. Well, I guess you could, but you'd end up having to split every single fringe cost 2 ways, and that's more trouble than it's worth. Just having a separate fringe pool is easier. So another way to think about this 2-tier structure is I have a fringe with a labor base, I have an overhead with a labor base, and since the bases are the same, I could just add those two together and give me a combined rate, or I can just put all the cost in one pool. I get the same result either way. The 3-tier structure is the one we've talked the most about. That's almost everybody's usage. If you've been looking at the percentages in the headers, you saw that about 2% of government contractors use a single element base. About 5% use the 2-tier structure. That totals 7%. And that means 93% of government contractors have a 3-tier structure in one form or the other. They have a pool for fringe, sometimes multiple pools, but 1 tier for fringe. They have a pool for overhead, sometimes again multiple pools. Some contractors will add together labor and fringe and use that for their overhead base. It doesn't matter in most cases. It gives you the same result until you have multiple fringes, and then it can cause a real problem. That's a little more advanced topic. If we have time, I'll talk about it right at the end. And they have a pool for G&A, typically with a base of either total cost input or value added. Simply because as government contractors grow, they tend to have some non-labor costs that become material, whether it's a subcontract or a materials cost. And as soon as that cost becomes material, DCAA wants it to be in the base for some allocation pool, whether it's an SCMH pool with a value-added base for G&A, or whether it's lumped in with all your other costs on a total cost input basis. But you can't ignore it anymore like we would with a single element G&A base. This one is the most often used. It's the one DCAA sees the most. They understand it. Doesn't mean they like it, but they do understand it. And it's taught in all of the auditor schools and the contracting officer schools and training. I've actually taught DCAA courses down at their training center in Memphis, and they almost exclusively teach this structure. They don't even talk about the other two to any extent. So here's our first survey. Donna?
Okay, thank you, Rich. So we're going to go ahead and launch our first survey, and the question that you will see on your screen is, what is your pool structure? So we're going to take a minute, if you could all just answer this pool so we can get a sense of the audience out there. And I see the answers coming in. We'll wait another few seconds. And it sure does look like the 3-tier is coming in the winner.
That was kind of to be expected.
Right.
I'm curious to see how many are going to be in that 4th category where there are multiple fringes or multiple overheads.
Okay, so I'm going to go ahead and close it now, and I'm going to share the results of the pool, and there you have it. So we have the 3-tier, 57% of you that have responded are using the 3-tier structure. We have 3-tier structure with multiple fringes and overheads at 29%. And then from there, we'll go to the 2-tier, which is 6%. Other tiers, which is kind of interesting. I don't know what those are, but those are 5% of the audience. And then we have the single pool at 3%.
You know, it's interesting. I've done this same presentation probably 20 times in my career, and never, ever have I asked this question without having somebody in the other category.
Okay. Okay, great.
What's really interesting for this one, though, for me, is that we have so many companies moving toward multiple fringes or multiple overheads.
Yeah. That's
been a definite trend the last few years.
Okay, we'll go ahead and hide this and go back to the presentation.
You've probably noticed there's an awful lot of material here, and since I can't talk as fast as I probably should because of my heritage, I grew up in LA, that's Lower Alabama. So talking fast is an unnatural act for me. You'll just have to listen fast to make up for it. Okay, invariably things get complicated. Either multiple fringe pools, multiple overhead pools, but remember, the regulations only allow you to have one G&A pool in a business unit. Business unit is kind of a flexible concept in government contractor regulations. It's not a set of books. It's not a legal entity. It is a unit that keeps a P&L and a balance sheet and has its own line of business. That's a business unit, and a business unit can only have one G&A pool. By the way, business unit equals company is firmly entrenched in DCAA's mind. You often have to convince them that no, you have multiple business units even though you only have one company. We'll take a short detour here for a second. Let's talk about wrap rates. What's a wrap rate? Well, a wrap rate's just shorthand for if I sell somebody $1 worth of labor, what's the sell price? If I sell you $1 worth of labor, does it cost you $2, $2.50, $1.50? What's my wrap rate? And that's all of your rates all tied together. So I have a fringe of 28, an overhead of 50. My base is labor for both of them, so I'm just going to add those together. With fringe and overhead applied, that comes to $1.78. And then I add my G&A to the total of all of that, and that gives me $2.05. So why I sell you $1 worth of labor? It costs you $2.05. That's my wrap rate, and that's at the cost line. So I haven't added any fee or profit yet. That's just what it costs me to sell you $1 worth of labor. So why do things get so complicated? We'll take a look at this one. This is a rate structure I did for a company 25 years ago. Company in Columbia, Maryland. I won't mention their name. We had three very distinct segments of the company that operated differently. We had companies that worked primarily in New York City, Los Angeles, San Francisco, Atlanta, and downtown Washington, D.C. We called those offices major metropolitan areas. We had companies that worked in field offices, places like Fort Rucker, Alabama, and Fort Benning, Georgia, right outside the gates. They were still our facilities, but they were in very definitely low cost of living areas. And then we had a number of employees that worked on customer sites, and their overhead costs were very low, basically just some supervision, and that's about it. We also had multiple fringe rates. We had people that got full fringe, the health and welfare, the fringe benefit, the payroll taxes, the paid absence, and then we had a reduced fringe pool, and these were basically retirees that already had perhaps health and welfare benefits from a previous job. They had some things they didn't need from us, and so their fringe rate was basically just payroll taxes and a little bit of paid absence. I think we only gave them holidays. Then there was a dead minimum fringe, and that was just payroll taxes and other legally mandated things that we had to do. Now look at the matrix that's formed by those three overheads and three fringes. If I needed to bid a job at a 2 multiple, I used field office people with reduced fringe. I got a 2.04. If I really needed to race to the bottom, I used customer site employees and the minimum fringe folks, and I got a wrap rate of 1.45. Even in today's LPTA environment, I bet you 1.45 is a winner. And when it was sole source, and I didn't have to compete, and I could do it in New York City, I did. And I had a 2.6 multiple for those guys. So why does it get complicated? This is why it gets complicated, flexibility. So here's our second survey. What's your primary wrap rate? Now I know that a lot of you have people that work in multiple areas, some customer site, but most of your work is probably in one specific overhead pool. What's your wrap rate for them? Let's do another survey.
Okay, let's go ahead and launch this survey. And you should now see on your screen what is your primary wrap rate, and if you can go ahead and answer. Okay. Thank you to all the audience members who are responding so quickly, and they're coming in. We'll wait another second or two. Okay, we'll go ahead and close the poll and share it. And there we have it.
Wow, look at that. The vast majority of them are between 1.5 and 2. I very rarely saw a wrap rate below 2 5 years ago. and LPTA, low price technically acceptable competitions, have done this to our industry. It's if not a race to the bottom, certainly a push to go, how low can you go?
Okay, thank you. I'm going to go ahead and hide that poll and we'll continue.
Let's talk about developing rates. I always get the question, what's the right rate structure? And the right rate structure is the one that your regulators are comfortable with. DCA is going to look at it and smile. And it allows you to recover all your costs, because you don't want to leave any cost on the table because you bid a rate that's too low and you can't live with it. And you have to be able to win with it. The best rate in the world that doesn't let you win is no good. So the right rate structure is one you can sell to your regulators, you can sell to your customers, and it still lets you recover all your costs. Here's just some basic advice. Stay mainstream as long as you can, or unless you've got a really, really good reason to get complicated. Don't complicate unnecessarily, and if you don't do anything else, keep your pools as large as you possibly can. There's a reason for that. Very small pools are very volatile. So if you have a pool that only has 10 people in the base, all that has to happen is for one of those people to go out with a heart attack or some other medical problem, and boom, your base just went down by 10% and your rate just went up significantly. So keep the pools as large as you can and pick a structure that has enough flexibility that you don't have to change it every single year, because there's nothing that really bothers DCAA like a rate structure that won't stand still. So when are you supposed to develop your rates? Now, this is a case of do what I say, not what I do, okay? Because nobody actually does it. But you're supposed to do your estimates at least 90 days and submit them to the regulators before your year starts. 90 days before year end. That means by September 30th, you ought to have your rates done for next year and submitted to your ACO. Notice I didn't say DCAA. Your rates go to your ACO. Now, almost everybody copies DCAA, and the ACO actually appreciates that. But the ACO sets your provisional rates for each year. Now, those of you who are not DoD contractors, you don't have an ACO. Your contracting officer does both procurement and administration, so it's your contracting officer. Most of the agencies that you do business with probably have a basic layout of how they would like your rates to be disclosed to them online. I know you can get one from DCAA. They have a sample rate structure that you can download. NIH has one. I know the Centers for Medicare and Medicaid Services have one of their own. NASA has one you can download. Stick with the recommended elements in those pools unless you have some kind of costs that are absolutely unique to your company and you have a really good reason not to use their descriptions or their templates. By the way, on those account descriptions, use theirs. That's what they're looking for. So even if your company culture says that you call things different than the government does, consider using theirs for your rate submission. And an estimate based on your experience or your judgment is better than leaving things out. So don't hesitate to make a judgment call, put it into your rates, and simply flag it as this number is based on experience or my judgment. So use your prime customer's preferred calculation model if they give you one. And don't reinvent the wheel. If you work with a prime or a mentor that has a good rate structure that you like and could work for you, use it. Plagiarize it. Borrow it. If they won't let you borrow it, steal it. The fact is, these rate structures are absolutely common across our industry. Every single government contractor is absolutely unique. And you know what? They're all just alike. Because the government forces so much structure on us with its regulation, our accounting tends to be absolutely cookie cutter. Now, it doesn't have to be completely unique. If it was, nobody would win because everybody's rates would be exactly the same. But don't try to reinvent the wheel. All right, let's talk about all those rate submissions. You're supposed to submit forward pricing agreements to the ACO or your contracting officer if you deal primarily with civilian agencies. And the regulation, FAR in this case, says that the government will negotiate a forward pricing rate agreement with your company. Now, that doesn't happen. It does if you're Lockheed or General Dynamics or one of the other huge companies. If you're not, chances are you're not going to get a negotiated forward pricing rate agreement. And frankly, that's probably a good thing because they don't really work to your advantage anyway. I actually was talking to the former head of DCAA just a few weeks ago, a fellow named Charlie Wilson. Charlie told me that throughout DoD, there were less than 100 negotiated forward pricing rate agreements. And half of those were all in about 5 companies because they do them by business unit. If you don't have a forward pricing rate agreement, so what do you get? Well, the answer is probably a forward pricing rate recommendation. Your ACO is going to set when he wants to see those forward pricing documents from you. That is not established in the FAR. In fact, it's not in there anywhere. They try to set the time enough to permit DCAA to at least look them over and develop a negotiating position. But as I said before, forward pricing and rate agreements just don't happen anymore. So DCMA, the Defense Contract Management Agency's internal guidance, requires them to develop an FPRP for contractors, FPRR, excuse me, for contractors with more than 200 million in annual sales to the government, or an FPRA, and there just aren't very many of those. So an FPRR is a forward pricing rate recommendation. That's internal. It doesn't require your agreement. It's what DCMA is going to recommend to agencies as being your most likely final indirect rates for next year. So what's the result of that? Well, 2 things. Forward pricing rate recommendation is going to result in forward pricing rates for you to use in proposals, but it's probably also going to result in provisional indirect billing rates. Now those are supposed to be set by the contracting officer within DoD, that's your ACO. And the regulations provide that the rates could be prospectively or retroactively revised by mutual agreement. In reality, it's not by mutual agreement at all. The government dictates what those provisional billing rates are going to be. But the key there is to prevent substantial overpayment or underpayment. So whether the government is paying you too much or too little, either way, the regulation says the government should fix that by revising your provisional billing rates. And that gives you a lot of ammunition to do some things that you want to do anyway. We already talked about this. It's good that some of this material is in here in a lot of detail that we don't have time to really plow through, but when you get a copy of this, it's good reference material for later. Billing rate proposals should include all the calculations so that they can clearly see what the pools and the bases are and how those pools are applied, how the rates are applied to bases in your proposals and in your bills. Common proposal pitfalls for provisional indirect rates is including unallowable cost in your pools, not including unallowable cost in your bases, or simply submitting the prior year's rates and assuming the government will just go along with them for another year. Actually, the government does that far too often. they just let you continue billing last year's rates into the next year without establishing new provisional billing rates. If you have that option, you should not let the government do that. Even if the rates are the same as last year, submit numbers to substantiate that and make them approve them again. Because if you need a revised provisional rate, you don't want to do it 2 or 3 years at a time. You want to do them year by year. The issues that arise with provisional billing rate requests most often is simply that there's no response from the ACO. Some of the ACOs, some of DCMA's offices are better than others. Some of them are very quick to respond on those things. I'm going to do a shout out for the DCMA office down in the Hampton Roads area. They are extraordinarily responsive. I've had responses on provisional rates with an up or down in as little as 4 hours after submission. And that's just unheard of. Those guys are really on the ball. Some of the other offices are almost as good. Some of them could do a little better with their responsiveness. So one of the issues is that provisional rates no longer go to DCAA. They should go to the ACO, at least for the DoD folks. Copying DCAA is encouraged, and it will get you a more responsive action. A lot of contractors don't resubmit through the year. They should. A few contractors don't submit provisional billing rates at all. They wait for the government to do something. The government is not proactive. I know that comes as a huge shock to you. But if you let them not do something, they're content to not do it for a long time. Don't wait for them to do it. The forward pricing rate proposal and your provisional rates aren't necessarily the same. However, the regulations say that if they aren't the same, auditors are supposed to comment on why they're not the same. Normally they will be. They're not required to be. And occasionally there are good reasons why they're not. Because there is a lot of interdependence between billing rates and pricing rates, even for the current year. Auditors expect them to be the same, and when they're not, they're supposed to explain those differences. There are a few submissions that don't have much to do with rates, but they're kind of key. One of the things is in the incurred cost submission as supplemental Schedule D, and it's called the accounting system description. The accounting system description should be a one-pager. If you can't do it in one page, get some editing help. It should not be detailed. It should basically simply say what kind of costs you put into your French pool, your overhead pools, your G&A pool, and what the bases are for application of those rates. If you didn't do anything but type out my rules of thumb on a sheet of paper, it would be a pretty good system description. If it goes over a page, you got a problem with complexity or how it's being described. The CAS Disclosure Statement, if you are covered by cost accounting standards, and that is something that has become almost a lost art, figuring out whether you're CAS covered or not. I talked to a company just the other day that said, oh no, we're not CAS covered. We only have about $30 million a year in revenues. I said, well, let's take a look at your largest new contracts. And they hauled out one that was about $12 million a year, and it had 4 $12 million options, the one-year contract with 4 one-year options. I said, guys, you do realize that CAS regulations count unexercised options. So take 12, multiply by 5 years, you got a $60 million contract on your hands. You just became CAS covered. They didn't know that. It's worth a review, or talk to your CPA firm or your advisor about taking a good look at whether you're CAS covered or not, especially if you're in that $30 to $50 million zone where you could be winning contracts with unexercised options that could trigger CAS coverage. If you are CAS covered, that has to be submitted along with your provisional rate submissions and your forward pricing rates. That's how they know how your rates work. So when do you do course corrections? No, well, anytime you need to. Anytime your year-to-date rates vary significantly from what you're being billed or what you're billing the government, and that significant difference causes either over or under payments, then you should do a course correction. At the very minimum, I tell people to consider doing one at mid-year and then again at end of the year, even if the differences are relatively small. The FAR in particular says when a contractor becomes aware the government has overpaid, then the government shall remit the overpayment amount to the government, and the time frame for doing it is very short. I think it's 30 days. It's hard to do that without revised provisional rates. Good news, even though the regulation does have some pretty draconian penalties for not doing it, it's very, very rarely applied. What they want is for your rates to reflect your actual costs. So why do a year-end correction? Well, cash flow. And the third reason would be cash flow. Remember, in our business, cash is king. Of course, there's that little pesky ethics thing related to overpayments, but the real reason is cash flow. If you've finished your year and you've got, say, $40,000 or $50,000 in rate variance where your overhead or your fringe or G&A or maybe combination was slightly higher than what you were billing, that's worth $50,000 on the last day of the year. And that's when you should get a revised provisional rate for the year and bill it. Because rate variance is almost like a radioactive element. It has a half-life. 6 months from now, that $50,000 is probably worth $25,000, reflecting your probability of ever collecting it. Another 6 months, it's worth half that. Another 6 months, you probably should just write it off. So don't wait. Bill it now. So as soon as possible after year end, and you're not out there trying to do something unique. This is actually contemplated by the regulations. The Defense Contract Audit Manual, which is not regulation, but the auditors tend to view it that way, actually tells the auditors at year end, compare the billing rates with what the actuals are, and determine if the billing rates need to be adjusted. Now, remember what I told you about the government? They're not proactive. They're not going to come in and look at your billing rates versus your historical rates and do this. But you can, and your justification for asking for revised provisional rates is that section of the DCAM. The same area of the DCAM tells the auditors that they should not wait to get your final indirect cost submission 6 months after your year end to do that correction. I've had auditors actually tell me, oh, you can't bill for your actuals until we audit your provisional rate proposal, your final indirect rate proposal. And that's simply not true. You can revise your provisional rates and bill it. I've done it as early as January 15th for a year that ended 12/31. The DCAM, again, actually tells the auditors if the claimed cost on an incurred cost proposal exceeds the billed cost, they should advise the contractor to submit an interim claim for the difference. Now, they don't do that. In fact, sometimes they will tell you you can't do it, but you can. And the DCAM says you can. Of course, the reverse also applies. If your billed costs exceed the claimed costs, you're supposed to adjust that on the very next voucher after you submit your incurred cost proposal. And speak of the devil, there's that incurred cost proposal. The ACO for DOD and the contracting officer for the civilian agencies is responsible for establishing the final indirect rates for your completed years. Not DCAA, not an audit branch, not your CPA firm. It's the contracting officer. DOD is the only agency that has a separate branch with nothing but administrative contracting officers. Most of the civilian agencies, one contracting officer does both procuring and administration. But that's where the authority and the responsibility sits for establishing your final indirect rates. There's a clause in the FAR, 52.216-7. It's burned into my brain. Allowable cost and payment. That's the source of the requirement to submit an incurred cost proposal, or an ICE model if you're DOD. That clause is in all cost type contracts and all time and material contracts, which comes as a little bit of a shock occasionally to a contractor who has no cost type contracts and thinks because they have only time and material contracts, they don't have to do an incurred cost proposal. I talked to a contractor like that just a few weeks ago. They were a little bit unhappy to find out that they were having to go back and do incurred cost submissions for prior years. In fact, last year, with a different company, I might add, I had a client that had not ever done an incurred cost proposal because they only had T&M contracts and had to do 7 years of incurred cost proposals all at one time. It was actually worse than that. I had to do 7 years of incurred cost proposals for that client all at one time. There are worse things, but no, they're not. The regulations changed a mere 6 years ago. Now, 6 years sounds like a long time, but remember, government regulations move at a rate that makes crustal plates look like speed demons. So 6 years is nothing. Before 2011, a contractor's incurred cost proposal just had to be adequate, and it said nothing about what comprised adequate. For contracts awarded after June 2011 or modified to have the new allowable cost and payment clause in them, then all of a sudden the requirements have gotten very, very specific. There are actually 30 very specific schedules that are required by the new allowable cost and payment clause. There are 15 that are mandatory. They have to be submitted upfront in order to be considered adequate. And there are 15 more that are now, that used to be called optional, they're now called supplemental. And you don't have to submit those along with your incurred cost proposal, but you do have to submit them before the audit starts. So why wait? Go ahead and do those 15 supplemental schedules the same time you do the others. Even if you don't submit them, put them in the file and hang on to them until the audit comes around. Because doing those 3, 4, 5 years after the fact is really hard. Doing them while the data is still current is much, much easier. Due date, 6 months. It's not 180 days. It's not any other date. It's 6 months. If you're on a calendar year, June 30 is your deadline for the incurred cost proposals. You can ask for an extension from your ACO. They won't give it to you. I must have asked 50 times in the last 5 years. Not once has the ACO written back and said your extension was approved. However, there's some good news here. Nothing happens. At least not for the first 3 to 6 months. And then you get a nasty letter and the ACO says you haven't submitted and you need to submit, and they call you ugly names. 6 months later, you get a threatening letter that says if you don't submit an incurred cost proposal, we're going to unilaterally determine your rates. And then a year later, you'll get a follow-up letter that says, okay, we're going to unilaterally determine your rates. And of course, that's the same thing they said last year. The whole time scale takes about 3 years to get to the point where they're actually willing to do something, and that's bad. Meeting that June 30 deadline is a good thing. If nothing else, it starts the clock running for when they have to audit, because receipt of an adequate submission starts the clock. Now, DCAA for a while thought that if they rejected your submission, even if it was 3, 4, 5 years old, been sitting in their files for 3 years, they could restart the clock on that statute of limitations. It's not true. The courts have been very clear on that. If DCAA got a proposal, they can't just restart the clock by rejecting it and having you change some, in some cases, pretty minor thing in the proposal and ask you to recertify. And even if you do recertify, that doesn't necessarily restart the clock either. Of course, once you get that submission in, they're going to audit it. The question is, when are they going to audit it? And the answer is, oh, maybe 4 or 5 years. Could be as little as 3 years. Yeah, the FAR says it should be done within, I think, 30 months for large companies, 36 months for smaller companies. DCAA is way behind. They've been behind for years, and I don't see that getting much better. Most people think that it has to be audited. It's simply not true. Nothing in the FAR says that the incurred cost proposal has to be audited. And in fact, I've had ACOs look at the incurred cost proposal submitted by a contractor and say, yeah, it looks good to me. We'll take those. In fact, I had a client last year that had 3 years worth of incurred cost proposals accepted all at once, and the ACO just accepted it as submitted. But, of course, the vast majority of them actually are audited. There's a program for that audit. All incurred cost proposals audited by DCAA go through program number 10100. I think the most recent date's August 2013. You can download a copy of whatever the most current audit program is for your incurred cost proposal at www.dcaa.mil. Remember the .mil part, because DCAA is ultimately a military organization. They're part of DOD. Don't go to dcaa.org, .net, .com, or any other dots. They exist out there, but they're not DCAA. Only .mil is the DCAA address. If you want to know how the ACO is supposed to proceed, they also have an instruction. It's instruction number 125, and you can get that at dcma.mil. Audit due dates? No. DCAA does not set due dates for their own work. They will make no commitments on when they're going to audit your incurred cost proposal. Auditing it sooner rather than later is in your best interest. Anything you can do to facilitate DCAA auditing your incurred cost proposal is a good thing. There are a number of issues around incurred cost proposals and audits today. This number, 19,000 incurred cost proposals that need to be audited, is a couple of years old, and it has not changed. At least 12,000 of those are 3 years old or more. They claim to have disposed of about 2,700 incurred cost proposals this past year, either by auditing or by simply classifying them as low risk and letting the ACO accept them as submitted. But they got about that many new ones. So this backlog, unfortunately, seems to be a permanent standing wave. It's simply going to be there until something else happens, and we don't know what that else is anymore. 27 months. I said 30 a few minutes ago. I apologize. 27 months is the established target for major contractors and 36 months for non-major contractors. It just doesn't happen. The most common findings on an incurred cost proposal audit is adequacy. First of all, they like for you to use their ICE model. It's not required, but not doing it is sort of swimming against the current. It'll make you really, really tired, but doesn't get you anywhere. Not including all the required schedules is another common one. The most recent ones that I've seen rejected were rejected because the contractor did not include the executive compensation schedule, which a lot of contractors believe that if they're a small business, they don't have to submit that, and it's simply not true. Everybody's required to submit it. And then contract briefs, which used to be optional, are now supplemental. And when DCAA comes to audit, they expect you to have those supplemental schedules prepared and ready for them to look at. If they don't exist and you have to create them, they will simply cancel the audit and go away and come back later. Not a good thing. We don't want to do that if we can possibly help it. Missing documentation, unreasonable executive compensation is probably the most common one I see anymore. And bonuses and incentive compensation. FAR has a provision that says that bonuses and incentives are only allowable if they're paid pursuant to an established plan. DCAA interprets that as written. It is not necessarily a written plan. Doesn't have to be. It only has to be an established plan, even if it's only established by practice. So if it's a company's common practice to do bonuses and incentives a particular way, those costs are allowable. Now, if you just suddenly decide to pay incentives 1 year after having never paid them before, it would help if you have a written plan because you don't have an established plan at that point. Statute of limitations have been an issue, and the recent court cases have definitely established the date of submission as being the date the contractor certifies it, unless there are major missing pieces. By major, I mean something that materially affects the submitted rates. There have been a lot of issues around the settlement of rates, and I'll let you go through those when you get the final issue copy of these slides. There has been a distinct trend the last few years toward multiple fringe rates, and I think you can understand why from that matrix I showed you a few minutes ago. There is a distinct trend toward classifying employees as being full benefit employees or partial benefit employees, and some have as many as 3 different kinds of fringe rates. Certainly, there's a distinct trend away from putting fringe in the overhead base if you have fringe, multiple fringes. And the reason is very simple. If you have fringe in your overhead base, then the amount of fringe that an employee has applied to their labor will determine how much overhead is also applied. So you could have 2 employees who sit side by side at the same desk, doing the same work on the same contract. One of them gets a very low base fringe, the other one gets full fringe. One of those employees will get more overhead applied to their labor than the other if fringe is in the overhead base. DCAA will always reject that as an improper allocation of overhead. So my advice to clients for the last few years have been, don't put fringe in your overhead base if you can help it, because it will cause problems later on when you want to have multiple fringes. So is fringe in your overhead base? Last survey.
Okay.
And this was going to be a quick one. You've only got 2 answers to choose from.
Okay, if you could go ahead and answer those. We'll wait another minute or a second or 2.
And by the way, we're not going to tell anybody what you say.
Okay, let's go ahead and take a look and share the results.
Wow, close to 50-50.
Okay, we'll go ahead.
Interesting.
Go ahead and hide this.
As I said, I definitely recommend against it. If you have questions about that, you'd like to contact us later, please feel free. One of the things that we can do for clients is help them manage those indirect rates.
Right.
Donna?
So thank you, Rich. So so everything that Rich has talked about, I think we can make life a little bit easier for you in some of the things that the Unanet solution provides. And I'm just going to give you a couple of really quick snapshots of some of the areas of Unanet just to whet your interest on how we as a solution and as an organization can help you with your indirect rates and some incurred cost submissions and some of the other areas that Rich has talked about. So this is just simply a pure reference report straight out of the Unanet system to demonstrate that we too can define a 3-tier structure, or frankly any of those tiered structures that Rich explained in the Unanet system. And above that, in Unanet, you can also take each of those pools and record a rate, 3 different types of rates to use in your reporting and your billing and your forecasting. So of course you have your actual rate that Unanet calculates for each of those pools. You also have a provisional rate for billing purposes, and then you have a third rate, a target rate that allows that you can use for some what-if analysis and budgeting purposes. So you have the flexibility to define your tiered rate structure in any way you really want. We haven't come across any that we haven't been able to support.
No.
Another important, and this is a little bit small, but when you get the presentation you'll take a look at it, but one of the nice features in Unanet is the ability to generate a one-page statement of indirects that outlines, lays out for you in clear format all of your accounts and all of your pools and rates moving from left to right in the order that they're calculated. And so you can clearly see in one presentation how the rates were calculated, what was in your pool, what was in your base, and what was the resulting rates. Over and above that, you also have some columns to the right that highlights when particular accounts were excluded from a calculation of rates, and so you have a sort of a checks and balances here to ensure that you go back and include that perhaps missing account in your calculation of rates. Now, of course, some of those accounts are correctly omitted from the rates, such as some of your unallowables. And then we also wanted to just give you a sense of how those rates are applied in some of the reporting that is delivered with Unanet. This is one of the classic project status reports that's in Unanet, where you can look at the status of a job and a contract and the tasks on that contract with both direct labor, your subcontractor labor, all your ODCs, and of course your allocated and applied indirect costs. And those can be picked up, depending on what structure is being used for a particular organization or project. And lastly, I wanted to highlight something that is tangential, and actually probably more than tangential to the conversation today, and that is a survey that Cohn-Resnick, an accounting firm, and Unanet jointly hosted and sponsored. And there's a lot of different financial metrics that are presented in the results of the survey, but one of those is to take a look at the overhead rates, both government rates and contractor rates, on-site, off-site. And this is based on the size of an organization, the revenue for that organization. So just real quickly, when you look at the upper left-hand corner, the government rate, 35% of the respondents had overhead government rates less than 15%, and the colors represent the revenue associated with those organizations. So it kind of weights what Rich was telling you about earlier on common, rates, overhead rates, and there's also slides on fringe and G&A. But it does gives you a little bit more detail on where an organization may fit. If you want more information on this survey, or you would like to participate in the survey, which is still open for another few days, we'll be sending you that link in our follow-up email. So that is what I have. Very quick information about Unanet. I wanted to also share with you our contact information, both Rich's and mine. And feel free to reach out to us with any questions. And I think we are truly out of time.
We are 2 minutes over, for which I apologize, but it's a lot of material to cover.
So I want to thank you very much for joining us today. And again, keep your eye out for a follow-up email with some important information, the presentation, and some key links. So thank you and have a wonderful day.